All right, we have more changes unfolding in the U.S. economy and the U.S. real estate market. Changes that just gave us a glimpse of what's really happening behind closed doors with the release of the Fed minutes yesterday, showing an awfully hawkish Federal Reserve delivering some clarity on what they really think, what they really believe is happening. This is a look behind the FOMC curtain, folks, particularly with regard to what they're most concerned about, the sectors facing the largest headwinds in the coming months, with particular attention given to CRE, and what they're also most concerned about with the housing market, if what they're doing will correct home prices or not. They talk about all of this in the minutes, how home prices are way over fundamental values, as well as what they believe could be a painful end to 2023. But before we get started, if you're not already a subscriber of this channel, consider subscribing. It helps the channel out, and I appreciate your support. So the Fed minutes were released yesterday for the last FOMC meeting as they wait 3 weeks to release them. Now, I watched some commentary on financial media about this yesterday, but in my opinion, they're missing completely the most important part of the story. These minutes are important. Why? Because they express the views of the FOMC members, the decision makers, the people who are making monetary policy for our country, what they're arguing for, what they're arguing against, and why. It's not a complete picture whatsoever, and they clearly remove the real juicy tidbits, but it's as much of an inside look at what really happened in that meeting as possible, which is why it's important to look at, and it was worth the wait, because what they said, what they summarized, was what we wanted to hear, folks. Because at times when you're investigating these new stories or digging into new research about new data that comes out, I personally often wonder if the Fed even sees some of this stuff or recognizes it, or if it's possible that they're interpreting it differently than I am. But these minutes sum it up. We are on track. We are en route to our destination. And before looking at the actual minutes, let's just lay out what's really happening right now. Based on their data, the government's data, the Bureau of Labor Statistics, they say that we have a record low unemployment rate, 3.5%, they say, which isn't good, by the way, because they want to see it break upward, which means breaking the labor market. So at 3.5% unemployment rate, we have an asset bubble that makes '06 look tiny. Valuations for all asset classes extremely overinflated. We also have $5 trillion in corporate loans and $2.8 trillion in CRE loans coming to maturity in the next few years, about to see their interest rates double. We also have a stock market at all-time highs, company valuations so overpriced that even Warren Buffett can't find anything to buy right now, that he's sitting on the largest cash pile he's ever had, waiting to deploy it once the bubble pops. And I can keep going, by the way, with these. There's dozens more trigger points like those waiting to be tripped over. So with all of that as the backdrop, now put on top of that the Fed's 550 basis point hike in interest rates, 5.5% in the last year, in a financial system that's currently in the process of tightening lending conditions, meaning there is less money being lent out right now, drastically less loans. In fact, it's virtually as hard to get a commercial real estate loan today as it was during the meltdown of '08, like you see on this chart. Likewise, corporate loans have the same problem right now. And to remind people who may have forgotten, after '08, it was virtually impossible to get a bank to loan you money. Nobody was loaning anyone anything back then. Banks weren't even lending to each other.
The banks are getting better, but it's not good for anybody else yet, because the banks aren't lending, and they are not going to start lending until they keep getting better. So we're in this holding pattern where the banks aren't really doing much of anything right now. And a lot of people have been saying, are the banks going to lend? Are they going to buy treasury bonds? They actually really aren't doing either right now.
So I can't overstate it enough. The level of credit tightening that's already happened is bad. The effects haven't been realized yet. And according to these Fed minutes and the last sluice report, banks will continue down this path for the rest of this year and also into next year. All right, so that's where we currently are, right? Now take a look at what the Fed members were saying to each other at the last FOMC meeting. This is the meeting when they decided to hike the overnight rate to 5.25%, 5.5%. These are the actual minutes in PDF form right from the Fed's website. And what you'll notice when you read this is the constant reference to SLOOS, the Senior Loan Officer Opinion Survey. If you're a regular viewer of this channel, you know exactly what this is, as we've talked about it so much in the past. If you're new though, this is how the Fed determines how easy or difficult it is to obtain a loan. Very important survey right now, because turning off the loan spigot could have drastic effects. Extremely potent tool, and it's what they've been waiting to see the effects from. Here's what they write about this. Credit availability for businesses appeared to tighten somewhat in recent months. Credit from capital markets was somewhat subdued, but overall remained accessible for larger corporations. For small business, forget about it. They go on. In the July Senior Loan Officer Opinion Survey, banks reported having tightened standards and terms on C&I loans to firms of all sizes in the second quarter. Banks also reported expecting to continue tightening further over the remainder of the year. The July SLOOS also indicated that standards across all CRE loan categories, all commercial real estate loan categories, tightened even further in the second quarter, and that banks expected to tighten loan standards even more over the rest of this year. That was commercial, right? That was just commercial real estate, and for C&I loans, which are business loans. What about residential real estate, the housing market? Here's what they say. Credit in the residential mortgage market remained broadly available for high credit score borrowers who met standards conforming to loan criteria. Meanwhile, the availability of mortgage credit remained tighter for households without high credit scores. Banks reported in the SLOOS that they had tightened standards for certain categories of residential real estate loans over others to be held on their balance sheet, such as jumbo loans and home equity lines of credit, HELOCs. In addition, banks reported expecting to tighten standards even more for jumbo loans during the rest of 2023. Now, here's where it gets good. They write, however, in the July SLOOS, banks frequently cited concerns about the credit quality of both CRE, commercial real estate, and other loans as reasons for continuing to tighten their lending standards over the remainder of the year. Aggregate delinquency rates on pools of commercial mortgages backing CMBS increased. The members noted that asset valuation pressures remained notable. Actually, before we even read this, what they're about to go into is the real estate sector. And realize these are the thoughts of the FOMC members, the group of Fed governors and presidents deciding on our country's monetary policy. Should we hike? Should we pause or cut rates? Should we continue with QT, quantitative tightening, etc.? Here's what they were saying to each other during this meeting when deciding to hike a few weeks ago. They write, the staff judged that asset valuation pressures remained notable. In particular, measures of valuations in both residential and commercial property markets remained high relative to fundamentals. House prices, while having cooled earlier this year, started to rise again, and price-to-rent ratios remained at elevated levels and near those last seen in the mid-2000s. Although commercial property prices moved down, developments in the CRE sector following the pandemic may have produced a permanent shift from traditional working patterns. If so, fundamentals in the sector could decline notably and contribute to a deterioration in credit quality, which is exactly what we've been warning about on this channel for the last year. They particularly highlight and note the ridiculous buy versus rent ratio in the housing market, which we show all the time on our interactive maps. It's how it's completely out of whack, worse now, in fact, than it was during the run-up to the last housing crash back in '06. But the biggest takeaway for me, folks, is their consistent references to SLOOS and credit contraction. Like we said in countless videos now, that is the single most important report that these members are monitoring. It's at the top of their dashboard right now, along with other loan metrics. Mary Daly said as much in a recent interview, and the reason is because it's an unknown. There's really no way to measure how bad the results will be from banks tightening like this. Last time it happened, it led to the great financial crisis being as bad as it was. Nobody would lend money back then. That was the entire reason why they came up with QE, or quantitative easing, some made-up concept to funnel dollars into the system and attempt to give the banks confidence to start lending again. So listen to this. A variation of this sentence was used over and over again throughout the minutes. They write, participants assessed that the ongoing tightening of credit conditions in the banking sector, as evidenced in the most recent surveys of banks, also would likely weigh on economic activity in coming quarters. Now, what does that look like? Well, it probably looks like a spike in unemployment. What they want is for the unemployment rate to rise by a few points. But here's the thing, there's no way to do that with any precision. Once you break the labor market, it's impossible to deduce what the damage will really be. It may spike to 6, 7% when all they want is it to get to around 4%, a little bit less than 4%. A scenario, 6, 7%, that is a scenario that, they may actually be quietly hoping for, as it's a quick way to fix the housing market imbalances. One of the only ways in the short term to fix it. Bottom line, the end of 2023 into early 2024 is shaping up to be rough, folks. And I really think that if you're bullish right now, you ought to be very cautious and start implementing a hedging strategy. Just my opinion. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Press the dislike button. Either way, I appreciate you watching.